Jason, welcome to Trade Finance Talks TV.
Thank you, it's great to be here.
So, quick introduction, who are you, where are you from, and what do you do?
Great, okay, so Jason Barrass. My background is in trade finance, so I've spent the majority of my career working in emerging markets, some of the world's largest trade finance banks, always done trade finance. And then about a year and a half ago, decided to do something slightly different with the remaining years of my life, so jumped into credit ratings and joined ARC Ratings, which is based in the UK with a UK and EU license.
Thank you, and it's interesting because it's normally the other way around, isn't it? And that's why I'm really going to appreciate your answers. So why are rating agencies and ratings really important to the trade and commodities finance industry?
Yeah, one of the things I used to love to, little story I used to tell at conferences was how trade is one of the oldest banking products, okay? Started out, buyers and sellers were doing this like thousands of years ago. But it hasn't really developed that much over the last thousands of years with regards, we're still using paper, okay? And it's still complicated with regards to technology and terminology and stuff like that. So the role that credit rating agencies play, and particularly ARC, because we do specialize in this asset class, and also bearing in mind my experience here, we play a role in actually translating what the risk is to an investor. An investor, let's say a German pension fund, wouldn't actually know some of the terminology we use, irrevocable letter of credit, payables or receivables. But what they do understand is when we look at the risk and then say it's an investment grade, it's BBB or it's a single A, they can then reference that back to their other structured finance investments, etc., and know what the risk is in comparison to their other asset classes.
Yeah, and it's interesting because trade finance in its nature, it's short term, it's self-liquidating, and it's revolving. Why do you think we need to educate the fund management community around this notion of trade finance as an asset class?
Yeah, there's two things. So when we were just talking on the panel earlier about this, as an industry in trade finance, we've got to have a little bit of bravery to move outside of the parameters that we have. We love our industry, okay? We know who buys the asset, who sells the asset. Everyone knows what the terminology means. However, if we can start to embrace the broader structured finance techniques and products, you then start to open up a huge amount of investor base into this wonderful asset class. And part of that basically is understanding, okay, how the market works. It's utilizing greater structuring skills, okay, utilizing different ways of originating, taking away paper, removing some of the risks. And if you can start to do that, then all of a sudden you've got an American investor or an investor in Asia who understands the risks, likes the returns, and buys the assets. That then allows the banks to re-lend more and originate more and create that kind of like quicker movement of cash, which we know is the driver of GDP.
Yeah, it's interesting. We're removing the paper to produce another more interesting paper, and it's interesting because trade finance does have quite a good risk return profile. I guess in a world where interest rates are on the rise and a lot of equities markets are producing lower and lower returns, would you say that's making trade finance more investable?
I think so. End of the day, the trade finance market has a very unique way of originating transactions because, the underlying is a buyer and a seller, okay? It's short-dated paper, and there's normally discounts for playing early, right? It could be like 1-2%. When you annualize that out over the course of a year, there's a huge margin to be able to play with, which makes the attraction of the asset class even better for investors. Now, sometimes investors are a little bit suspicious if you turn it with a BBB paper and it's yielding way above what a normal bond is yielding. But if they understand how you can get that arbitrage, okay, you can get the better returns, and this is part of the education process that we all have to go through with fund managers and with ultimate investors, then they'll be more acceptable to taking those assets.
And where do you think the next few years will bring to the market when in terms of trade finance as an asset class? And what do we need to do to get there to really unlock that potential from additional funds and investments?
Sure. So in the structured finance world, which is mainly where we play, okay, so trade is just one of the assets that we deal with. There's a private credit market, okay, which has a subclass of trade in there, which is over $1 trillion, okay, just in the US alone, and Europe's like small comparisons, but it's coming through. That market is massive, right? Okay, and open to this product area here. So what we really need to do is start to get more of these assets structured correctly, digitized. Okay, we need more players to come through who basically are removing some of the historical risks that we're seeing, such as green sill, etc., etc. And we need to do greater education also amongst the credit rating agencies, some of my competitors, on the asset class as well. Because post green sill, there was several of them who issued papers saying this is a terrible asset class, we shouldn't do it. Well, they didn't understand it. Okay, and they didn't understand the risks, which is why ARC, we're a step ahead on that trade side.
Jason, thank you so much for your insights. Incredible to have you here, and thanks for joining. See you next time.
Thank you so much.